Everyone, thank you for joining me today. I'm Chris Seveney with Seveney Investments, and today we are talking partials. And I think today is going to be one of those episodes that this is a topic I love. And if people can get this into their um, portfolio and how to do this, I think it can be extremely powerful, which I'm going to show you later on. So, first, let's see, trying to advance the screen here. For those, again, who don't know me, I'm Chris Seveney with Seveney Investments. Gail Greenberg and I co-host the Good Deeds Note Investing podcast. Currently, like I said, manage about 200 active notes, and of that, 32 are partials that we're going to talk about today. And a few other things about me on the screen, but I'm going to roll right into this because this topic can get a little lengthy. So let's talk. We're talking partials. So first, what is a partial? It's basically you're selling upfront payments on to an investor. It should be on an asset that's low risk, and because you as a sponsor, the way I structure them, are responsible for any additional costs. So if you have a performing note that has $200 a month, 200 months left, you can sell 100 of those payments to somebody. That's basically as simple as it can get with a partial. One thing to note is the payment stream is principal and interest, and the reason that's the case is you've got a borrower paying you principal and interest. If you have someone do interest only, it can cause can cause problems later on down the line where basically to pay that person back their portion. So you want to have it mimic, for the most part, the loan that the borrower has in regards to payments. Now, you can have it be less than what the borrower is paying, so you can put a little cash in your pocket that we'll talk about later on. But I just want to make a comment that it's principal and interest. And that's a big thing because people think it's interest only and they're like, oh, I have a $5,000 partial and the payments, $300 a month. And then if it was interest only, the payments would be about $40 a month. So people look at it from that perspective and think the returns are low, but it's an interest on, what's remaining on that principal. So what are the rules of the game? I was thinking of Fight Club when I was writing these. If you've never seen that movie, the first rule of partials, you only do this on performing assets. And the second rule of partials is you only do this on performing assets. So I hope that this is clear as can be. Rule number 3, assets should have equity. It's not 100% mandatory, but when you look at risk, you want the assets to have equity, because if the borrower does stop performing, more than likely they're going to file bankruptcy versus taking the property back and having to spend money on foreclosure costs, which would come out of your pocket, that we'll talk about. Fourth rule of partials, always carry a reserve, and I will explain what that is. But if you are, and whatever money you get from that investment, make sure you excuse me, it's not coronavirus. Make sure you carry a reserve in case the borrower doesn't pay. I used to joke to people saying, hey, what are the chances of my 30 partials, everyone stop paying? Now I look at it from, well, now actually I could possibly see that happening based on what's going on in the world. So you never know what type of situation is going to come up. So always want to carry a reserve. And again, we're going to talk about that. And fifth rule of partials, if you spend reserves, never do it on a non-performing asset. And so the way to explain that is, if you sell a partial for $15,000, don't take that $15,000 and reinvest it. You can take a portion of it, and again, that's about risk and what level you want to take, and invest it. But if you do, you put that back into a performing note. And the way I'll say that is, if you spent $15,000 on a note performing and it's paying $300 a month, you sell that partial for $17,000. As an example, you might keep 2 in reserve, or, I like to keep 6+ months payments, which I'm going to explain all this and show it to you if this is a little over your head. And that 15,000, if you put it back out in the street, you put it back on a performing asset. So you basically, are doubling down on lowering that risk. Let's see. So some frequently asked questions that get asked a lot on partials as we go through these is, what happens if the note goes non-performing? What happens if the borrower pays off the loan? Do you record assignments? Who pays the investor? Do we wait till the borrower pays to pay the investor? So a lot of questions that I've written down right here. So the way I structure the deals is, if the note goes non-performing, there's 3 options that you can take. You can continue to pay the investor. You can have a pause period where it give you time to, get the person reperforming, or you can buy out that person. Is pretty much the 3 options. Typically, I go with option A. I just keep paying the person. What happens if the borrower pays off the loan? So if the borrower's UPB was $35,000, you have a $15,000 partial. I'll show you the amortization schedule. So if it paid off at month 8, you pay that person off, and you get to keep that balance, which goes to one of the questions lower down on that upside that we'll talk about. Do I record an assignment to an investor? No. I do not record an assignment to the investor. I have an agreement in place that is a collateral assignment and partial agreement that I'm not going to talk too much about today. We could do a follow-up, but I just want to show you the power of partials. But the reason I'm answering a lot of these questions is, if you go to look into doing partials, these are a lot of questions that you should be prepared to answer. Who pays the investor, the sponsor or servicer? Some people may set it up with their servicer to have them send the payments directly to that individual. I don't. I have it come through me, and I cut them a check. And kind of rolls into that next question of, do I wait till the borrower pays to pay the investor? No, typically I don't. If I have my partials, somebody's due on the 1st, I make sure they're paid right around the 1st. I don't wait to see, the borrower paid on the 3rd. And the reason why is, again, I got 30 plus of these to try and manage all of that. Would be just take too much time. What is the downside risk involved in partials? The risk is that if it goes non-performing, you're liable for the costs. So you definitely need to, make sure you keep reserves so you can pay for any foreclosure or anything that needs to happen. So that's why you want to make sure you're very selective on the assets that you use for your partials. Can this be done with CFDs? Yes, actually, I think it's better done with CFDs. And the reason I say that is either CFDs or non-judicial states. So if it does go into default, then your costs are less and your time is much faster from that perspective. So, and last question, someone said, why do you do this? What's the upside? Well, I'll show you an example coming up. But basically the upside is, you're not splitting, profits on anything. Basically, they've got a set, it's basically like a loan essentially against that asset. They're getting set payments. If the borrower, for example, if you sold $15,000 and UPB was 30,000, they pay that loan off tomorrow. That person gets their 15, you get to keep 15. It's not like, oh, I got to split profits or anything like that. It's, so there can be some considerable upside. Question came through, the investor, is that the purchase of partial? Yes, that's the purchaser of the partial, and that person assumes none of the risk of the underlying note. Correct. And I mean, there's still risk involved in the sense of, who the sponsor is, like in that sense. But, from the risk perspective, you're buying 100 payments, you're anticipating on getting those payments. If there ever was a fault with, the actual paper behind it and the loan was determined invalid, that's pretty much, or the sponsor steals your money. That's really the only ways, some of the underlying risk. The other is, and I'll get to this later on, is, looking at loan to value. And I typically try to have my partial partners have loan to values of 30-40% or less. So you're getting like a $10,000 or $15,000 partial, that property is worth 40,000, 50,000. So if it did ever have to foreclose, you're the first one out. So, the risk is, honestly, it's with anything in notes. Who, you know, who's behind it? Who's the person? There could be some bad deals and stuff, but on partials, that should be really, really low risk, because it should be a performing asset that's been performing for a period of time. You don't take a newly originated note and put it as a partial. Unless it's somebody who's got like an 800 credit score, then maybe that's a different story. But, you find, Tom, Dick, and Harry living down the street, basically, and make the three of them combined make $2,000 a month, and you're trying to put them in $500 a month payment that they barely qualify for, and they've had 4 foreclosures in the past. You're not taking that originated note and putting a partial on it, or if you are, you're gonna end up in trouble possibly. So let's roll into some of the meat of the case studies. And I put this up here because I think this is really powerful to show of really what happens in a partial. So you start in the upper left. You have a home. This one had a fair market value of around $95,000. It had a first position mortgage at $15,500 was a balance left at 9 3/8. So it had $250 a month times 93 months. Seller sells this to you for, I've got a zero missing, $11,000, which is a 16% yield after servicing costs. Okay. And, some people will say this is arbitraging, which in a way it is. And that's why you got to be careful with, the leverage, or, how much is being backed on this. So you take this note and basically you split it into 2 buckets, an A bucket and a B bucket, or think of a train. You got the lead car and then the caboose. So the lead car basically gets the payments until a period of time, and then you get the back end. So in these 93 payments, what I did is I broke it up into 76 to the investor, and I kept 17. So they got 230 because I took out $20 a month for servicing and so forth. So they got 76 payments, $230 a month, which was a 10% interest to them. That price was $13,000. And then I got on the back end 17 payments at $230 a month, which, do the math, is another, I don't know, $4,000 roughly. So, basically what I did is I acquired the steal. I sold the 76 payments up front. But if you notice, I bought it for 11. I sold the partial for 13. Okay. So I'm already up $2,000 on this thing. Plus, I'm getting 17 payments down the line. And I know people who sit there and, and I'm a yield guy, but, talk yield. Well, guess what? My yield's infinity on this thing because I have no money in this deal. So whether I get this money 2 years from now, 5 years from now, is the money worth less in 5 years than it is today? Yes. But guess what? I didn't pay anything for it. And that's, one of the things that I want to mention is really important is, if I'm buying something for 11, I'll try and sell it for additional, and I'll sell a little more payments, because what I'm going to do is I'm going to take this $2,000 or maybe even a little more and put that in a separate bank account as a reserve. And then this other 10, 11,000, I'll go out, buy another performing note, and rinse and recycle this thing. And I'll show you at the end how powerful this is. Okay, the question comes through. Will this be available after webinar? Yes, it will. So does this make sense for people? What I'm basically doing, I'm buying something for 11, and because it has more value to somebody who's passive, and I showed 10% on this. And the reason I showed 10 to the investor, and that's where I actually paid them, this is a real deal, by the way, is I hear people out there saying, oh, I'm selling partials at 5, 6, 7%, which great, these numbers look even better. But at 10%, I'm going to show you that these are still damn good deals. Okay, it's right. Okay, so this is basically what you're doing. Now, the whole premise of this is, okay, why do you do this? I'm going to compare this to a non-performing note. If I can get my screen to turn. I got them backwards. Hold on one second. Okay. So if you're buying a non-perform, this UPB at 16.5, on a non-performing side, you're probably going to pay, I don't know, $5,000, $6,000 for it. But, when you JV with somebody, what do you try and target for them? 12%, 15%. So at the end of the day, you're trying to target, say, 12% on a $6,000 acquisition. You're trying to get them like $1,000. I mean, it's not a lot over a course of a year. If this was non-performing, one of the things I ask myself is, because I bought this as a performer at 11, will you spend more than 5,000 to get this to perform? Probably not. So it's like, okay, if I bought evaluate a non-performer versus performer, kind of with the same UPB, where do things end up? But if you were to foreclose on this thing by the time you did everything, say you even made a 50% profit on that thing, you put $3,000 in your pocket, and $3,000 to your investor. And I'm looking at this through my eyes. Okay. Now, and again, I think people on here who buy non-performing notes, when you have to go through a foreclosure or non-performing notes and stuff, is it not a pain? I mean, it's a lot of work. Okay. And if you were trying to target 15% for yourself, or 20% for yourself on a deal like this, you'd make, even if you put 10,000 or 11,000 in a deal, you're trying to make what, $1,000, $2,000? I mean, $2,000 is 20%. I made that up front, that 2,000. As long as this thing stays performing, I just put that $2,000 basically in my bank. Okay, so I made 20% on a performing note right off the bat. People kind of follow how I got to that, because I bought it for 11, I sold it for 13, I made $2,000, and I didn't wholesale it. Okay, where I sold everything, I still got 17 payments at the end of the day as well. If I was dealing with a non-performer in this price point, when you got a $10,000 investment, you might lose, you may, make a few thousand. Again, say you made $5,000 on the whole deal. Okay. Investor gets 2,500, I get 2,500. Okay. And, you might get it in a year, but because I sold the partial for more up front and gave a few more payments up front, I've already got that money. Now people are going to say, if it goes non-performing, you have to put that money back out. You're absolutely correct. But also on a non-performing deal, you're not guaranteed to make money. You get an asset reperforming, that's going to be your best profit. But if you get an asset that you got to take back, you open those doors and look inside that thing, you ain't guaranteed, to be making that money. I've got a bunch of people on here who I've teamed with, and we've had some ugly stuff. So this is, just answering these questions here. Does that make sense to people? So let me go to case study number 2. Okay. This is one that, and these are interesting because if you target these type of assets, they have humongous upside to them. And I'll explain why. So this one, home value was 50,000. First position mortgage was 35,000. The interest rate on the loan was only 7%. Okay. So $246 a month with 320 payments remaining. Seller sells this at a 15% yield. That's 17,000. It's half the price. Okay. Think about that. Half the price you're buying this for. You're buying this for a non-performing price because of the interest rate. And again, this is a real live deal. I'm not making this stuff up. This is a partial that's in that I have. So I turned around. I split it into 2 buckets where I sold 138 payments for $18,500. and then I kept 182 payments. So I'm not going to see any money from this for 10 years down the line. Okay. So you're thinking, okay, but my whole game plan is, to build passive income, not now when I'm working full time, 5, 10 years from now. So basically, I still, put $1,500 into, that holding account at the beginning, and then sold off, 138 payments. But when you take 182 times 226, that's $40,000 of payments that I've just pushed down the road. But here's the thing. What if I went to this investor or this borrower, or, basically the borrower all of a sudden got married, something happens. What's the average time someone has a mortgage? 7 years. What if in 4 years this borrower turns around, paid this loan off? The person I sold the partial to, their principal is probably reduced, call it to 15,000. UPB on this thing's probably still in the high 30s. He gets paid off. I just pocketed $18,000. So that's why doing the partial versus a JV on something like this is so much more powerful. You do take on risk, but you also have that upside. So something that you have to weigh. It's up to you. It's really what you want to do, and that's why you kind of got to evaluate these things. And I also don't recommend the moment you buy a note, just roll it into partial. You want to hold it for 3-6 months to kind of make sure you understand this borrower. But again, here's an example of what I did. Okay. And, if we look at this again, same thing. If I was buying a $35,000 non-performing asset and say, value was at 35 to 50,000, say 35, because typically you buy, most of them are right around value. If I bought it for 14,000, would I spend more than 3,000 to get this performing? Yes. So basically buying non-performing note with these lower interest rates sometimes can be beneficial. But if this deal made, 50% on it, which would be a great deal, on 14 or even 17,000, you're making 3,500 or 4,000. Okay. So good money, but I put 1,500 kind of upfront, which is 11%. If I was targeting 12%, again, I made it right off the bat. So one thing I want to show you too is, okay. Hope you guys still see the screen. Oh, where'd it go? There we go. So here's kind of a simple calculator that I put together, okay, for people. So I did test case 1 and 2, property values, what the UPBs, the interest rates, calculated number of payments, what the principal and interest is, what I paid for it. And then I have here my target sales price, okay? And the way I target that is I try and target between 6 to 12 months of reserves, okay? So if there was a need to foreclose or do anything, I would have to, I'd have 6 months of payments that, would be paid to them, but also, you're still out of pocket your foreclosure costs. So that's why, again, you want to make sure that you have plenty of reserves, okay? The reserves I typically, bid these off of is, okay, the guy misses a payment here or there. I've got 6 months kind of in my back pocket. If the person, had to foreclose, that's money that's coming direct out of your pocket. So again, it's risky. This is high risk because you're in some instances. So that's why you want to make sure it's a note that is pretty, you're pretty confident it's going to stay performing. Okay. So you've got, basically, my target price, what I actually got the partials for. And then basically the second column here is basically the number of payments that I sold and what those payments were at what interest rate. And you can see, again, I try and target loan to values that are low. And then here's kind of my investor summary. On these two, I got 3,500 at my kitty, plus I've got, these payments coming through. I've got $48,000 in deferred income. on 2 partials. And again, it's spread out over a long period of time, but you basically, I feel like the Federal Reserve. I'm creating money out of nothing in some sense, if that makes sense, because yes, I bought something, I turned around and sold a portion of it for the value that I paid for it, and I'm keeping that back end. So I've just created value because I've got a passive investor who doesn't want to have to deal with non-performing assets or deal with a performing note on their own. So they turn around and will take it at a lower interest rate. Does that make sense, everybody? So one question that comes up is, calculating their payments. And, again, here's a calculator that gets attached to the contract, and say it was a, $18,000 at 10%, and it was, say $240 a month. Basically, we'll say, okay, they've got 119 payments, what their total interest is. All of this goes in the contract. So if, this started on, call it 5/1, and this thing paid off in December, okay, here's your beginning balance, here's your ending balance, and they paid it off, I would cut them a check for 17.2. It's like looking at a mortgage loan or a car loan amortized over time is what they get paid. So my goal with partials is basically back end a lot of performing loans that I use my own funds that from to put those funds back out, but then keep stockpiling these payments and stockpiling them on the back end. And how that works is, I'll answer that question in a second. So how powerful are these? So I keep a master spreadsheet that, as an engineer, you love. I have every partial, I whited out all the names. And then I have all these fancy formulas, if ors, if ands. Okay, here's how much is coming in the door. Here's how much I'm paying on a partial. Here's how much is servicing. And I use this as an example. I just plugged some numbers in for people because I'd be happy to share this. But what it would let you do is build over time to show you the end of each year, how much are you gaining from your partials. So I have, I'm going to be 45 at the end of 2020. So you can see the first 3 years, I really don't have much coming in at all. And then when I turn 50, all of a sudden, right now, I've got $5,500 coming in a month on average that year. Okay. And then it kind of tails off and so forth. And, my goal is to get most of these up to 10,000, but it's only 2020. I still have 5 years. And this doesn't include performing notes that I have in my portfolio. This is strictly just partials. So someone asked a question, is there a new assignment in launch when selling a partial? My contract it's a collateral assignment and a loan agreement is what is part of it. So if you added all this amount up, I have banked $500,000 in payments over the next 20 years of partials, from basically really starting with minimal cash in the grand scheme of things. And when I say minimal, 50 grand. So, and that 50 grand, keeps, feeding this because it just keeps getting recycled. And then, a portion of it stays for foreclosures and things like that. And, money for if I need to take a property back, but that just keeps getting recycled to continue to get this number to grow. Does that make sense for people? I wanted to show people 2 live examples of, basically two properties, one with $35,000 UPB and one with $16,000 UPB, and how, I turned quickly those into, what appears to be profitable solutions, which will pay me essentially what I may end up getting on a non-performing note, which I think these are less risk for similar returns. And this is why I love partials. Because for those who are on here who deal a lot with non-performing notes, it can be, they're head scratchers. So I'm just looking on who's on here. Chad, I know you've got your, you've got a lot of assets, so you've been through a lot of, had some hair, which we all have. I've got plenty of them right now with hair on them. But, I wanted to keep this brief for people, but also just kind of show you, simple ways of going back and breaking up, a loan that you take after you acquire it and then turn around and break it into pieces. Now, some things you could do, again, I give, Chad said I can say that again. Now, I typically give, 100% or close to, 100% of the money to the investor. But I could turn around and put in, instead give them $200 a month on this one. Their payments, went up by 40 extra months. So I get less months, but I do make more money, on the monthly side. So, it's something to consider. Depends on, and you can mix and match. You could do a few partials where, hey, I'm collecting $50 or $100 a month. If you have a $500 a month payment from somebody, you could turn around, sell a partial for $300 or $400, put $200 in your pocket for the time being, and give them, if there's 50 payments, give them 35 at that amount, and then keep 15 on the back end. There isn't a, you can create these however you want. You can give 10% of the payment coming in the door if you want, but you're probably going to be paying forever. I like to try and give more upfront because I'm not looking for the cash now versus cash later. Now, if you're a full-time investor, you may look at this and say, okay, I'd rather get some money now, $100, $200 a month now, and keep that because, that's your livelihood. So that's what you need, that money coming in the door. But, if you don't, you can defer it later, the better off you are. Now, one interesting thing that I'll mention too is, this money that I put into this account, I don't take it out or, and so forth. So I'm not taxed on it. It sits in the account, in a holding account as holding funds, just like if you had a JV deal that you paid 20 grand for and person put 5,000 in for foreclosure. It's the same thing. You're putting that money kind of in there, and it's not getting removed. So it's not something that is, getting taxed on. When you close out that deal, you can take that money, and then at that point in time, it would show up, on profit at that point in time. But until then, it kind of just sits there. So that's something else too, that you're stockpiling some reserves that are, can sit there, cash free or tax free in essence. And again, I strongly and urge everybody, if you're selling something for the 18.5, on this, that you're not taking that and reinvesting that whole amount. Could I talk a little bit more about taxes? I could, but I'm not a CPA. What I can tell you is that if you're doing this, interest is taxed at ordinary income. So that's, so if I make $500, it's like, and I made 25,000 in my day job, I made 25.5. It's not like rental income. Now, if you're the investor on this and I'm paying you, I'm issuing you a 1099 at the end of the year because you're not in the business of it, so it's different. So it depends, your question is if you're the one creating these or are you the one investing in them. Someone asked, my investors want to see collateral during due diligence. Yes, absolutely. And I provide it to them. So, so I provide them all that information. So they get to see pretty much everything. Well, and again, depends on who you're dealing with. I like to remain transparent on things, so I provide all that information. Others, I have no idea. I know I do. So you'll get to see BPO, note, collateral, everything that I get, you have access to. Wouldn't a monthly add-on be a problem in that case? I'm not sure what that question is about the monthly add-on. The reserves are, so here's the thing. Okay. On the reserves, you can make it whatever, you don't have to have any. And then, basically what you're doing then is you're just selling the partial for less amount. I'm taking what I paid for it and adding to what I paid, so it's not profit, it's reserves to the, to the to the entity. If I turned around and only sold it for 14,000, so payments went down to 87. So I'm losing 3,000 from what I paid, but I'm getting a lot more payments. At the end of the day, I'm netting 49.5 over time. I'm actually, the lower you sell it for, technically the more you'll probably end up netting, but it's a question of, I don't want to be out of pocket at this point in time. So, I base it, and it really depends. I try and target between 1,500 and $2,000 above, which, usually averages between around 4 to 6 months. Someone said, what's the market like for performing notes these days? I haven't shopped for them. Well, right now, people are afraid to buy them because of what's going on. But I don't know if anyone saw the news that they said, like 70% of renters didn't make their payments in April. Okay, so they're making this big deal about it. But does anyone know what the historical average is of people, renters per month not paying their rent? 70%. So they're making this big to do about 30% of people missed their rent payments last month. But guess what? It's 30% on average. I had so I went through everything I have. I had 2 people request forbearance. One of them is actually in bankruptcy where they did that they got COVID-19. So bankruptcy court gave them a free pass for the month, which I'm perfectly fine with. The other one is a borrower who hasn't paid in 2015, 16, I think was the last time he made a payment. So those are only 2 out of close to 200. I don't know. Anyone else who is on here, you do have performers, and how did how'd they do? Now, one thing I'll mention is performing pricing. Once this finishes, will probably possibly be, a little higher. Maybe you're not getting them for 15, maybe you're getting them for 14 or 13. But here's the other thing. You just turn around and, right now on the stuff that I'm doing these on, it's, 8%, not to 9%. It's not 10% anymore. I had some people who got 12%, at a point in time. But now, on the partials, I offer 8 to 9. I think the last round I sold to somebody was at 9%. So, just look at this. If that 138 goes down to 9%, it's 11 more months that I'm getting. So, something to consider. Okay, questions. So question was about taxes. If you're investing in it, it's similar to JV deal when you get paid. I mean, you'll get a 1099 at the end of the year. Um, and basically, I think it's 1099 interest that you give to your accountant and they'll take care of for it. I'm hesitant because I'm not by any means an expert in taxes. So I don't like to talk too much about it because I don't want to say something that's incorrect. Because the reality of it is, my taxes versus yours taxes versus, somebody who lives in Canada's taxes are going to be very different. So, the one thing I'll tell you is if you're using a, deferred account, IRA, solo 401k, then basically, the money grows in there and basically I don't even think my bookkeeper sends a 1099 at the end of the year. She may, but it's for a retirement account. Okay, question. Could you sell a partial on a performing second junior lien as long as the equity would cover the first and second? Ooh, I mean, you can sell a partial on anything. On a second, you could. I mean, I think your level of risk goes up a little bit. Now, here's the other thing too. With on these seconds, how much is their payment? You know, you gotta take that into consideration. You could. I don't do seconds. I have, like 1 second in my portfolio. That was a throw-in that the borrower's dead. But yeah, so I'm not a seconds person. I mean, you can do it with anything. I mean, in the grand scheme of things. So you could, would I recommend it? It really depends on what level of risk you want to take. Let me ask this question, people out there. Has anyone who's watching this, have any of you done partials? Would anyone consider doing partials after watching this? Either buy or sell. Now, from both perspectives, they're selling points. As an investor looking to sell partials, you get to replenish some of your cash. You are paying, 8, 9, 10% on it, which, is, higher than if you could go get a line of credit at a bank or something like that. But, on the flip side, it's locked into, that one asset. And it's kind of like a JV deal. It's you and that person with that one asset. So kind of you're riding that asset and so forth, but it's performing. So, you shouldn't have major problems. Like I said, I've had, over, 30 of these, and I've never ran into, knock on wood, any problems. And so forth. Have I had people miss payments and so forth? Yes, I have. But guess what? When you have 30 of these and buffers of 1 to 2,000, you got $50,000 slush fund sitting there where, okay, if I miss a few payments, they can be made. The key thing is staying focused at, okay, I put in a separate account, so I know it's specific for this, and I'm not going to steal Peter to pay Paul from it. And that's where people get themselves in trouble. You basically, I keep things separate and, just manage it as it goes and, um, follow each one. And it's good because, again, you get to replenish it, turn around and work on to the next one. Now, as a somebody who's wants to invest in these, you're getting stuff that, you get loan to values of typically very low if the property values are what they say. But even if they weren't, even if it was worth half, even if this thing sold for 25 grand, they're the first ones getting paid. The agreement says their first one's getting paid. So as long as that house sold for 18.5, they're getting their money. Now I may end up not getting anything out of the deal. from that standpoint, but that's, part of doing business. But I didn't have really anything into the deal from that component. So, there's that. So it's just like a note. You want to make sure it's insurance. You want to keep eyes on the property. I still send somebody by every property every 3 months, 4 times a year. I send preservation company. It costs me $20 per property to drive by, snap a few photos, and make sure it's occupied. So someone says purchase parcel provides good monthly income with nearly no maintenance other than making sure the income comes in. I think that rolling to partials like you're doing is a really powerful method for the long run. No, you're absolutely right. And there's people, there's a lot of people out there who, a, and I'll, can do a webinar on this. There's a difference between being a note investor and investing in notes. People who buy partials are investing in notes. You want to be a note investor, you have to set up your systems. You have to have attorneys and everybody else. There's a lot of cost involved in that. And honestly, it is a pain in the ass. And that's why you see, 500 people rush into this business after, taking some type of training. And of those 500, 5 stick, within 3 years. I can rattle off, I've been in this for under 5 years, and I could rattle off 25 names of people who at one point in time were all over social media about notes, and I haven't seen or heard boo from them in 6 to 12 months. So it's, and what happens is, it's a lot of work. It's not simple. And there's a lot of risk and there's a lot of management because, again, all of it's out of your control. I mean, you got to rely on attorneys, servicers, and everybody else. Um, so, and again, there's substantial costs with setting up that business and keeping, feeding the machine. At the end of the day, people who, have 100K or whatever it is sitting in their IRA account, what would you tell people right now? Hey, I'm going to go throw money in the stock market, or do you want to buy, 75 payments of a loan at $230 a month at a 14% loan to value? What seems like less risk. Now, stock market, again, much more upside. Your upside here is limited because it's to that, and plus you're getting principal and interest. So, eventually you want to look to reinvest that interest component to it. But, it's something that, over, and again, you do 1 or 2 of these, it's nice. But when you start doing, 20 of these as an investor, 20 plus, you can generate yourself some pretty damn good cash flow. So, get your mortgage payments paid for the next, 20 years, whatever it is. Like I said, the only challenge is, paying Uncle Sam all that stuff. Now, if you did it, here's it, really get you. If you did this with your IRA, you buy a performing note with your IRA, sell a partial, and then keep stockpiling these payments in your IRA. Now you're not even paying Uncle Sam till you start pulling this money out. Another option. So, I would consider this a little more advanced strategy. And the reason I say that is you got to be very disciplined, and you really got to make sure you understand notes and, what you're dealing with, from that perspective. And, making sure that you have adequate reserves and how to manage your business to make sure, what if, of the 32 I have, 10 of them go non-performing, do I have the cost cover it, and so forth and so on. You really need to evaluate that and not just go out and buy 20 performing notes and try and flip them into partials, because, you just got to be careful. Now, if you did that with your own money, then you got your money back. You should technically still have that money there, which should definitely cover you. But, a lot of people sometimes can get undisciplined. And when you start getting undisciplined, that's where you get yourself in trouble. What other questions? So how would I compare my back office for partials versus my back office for NPNs? I'll be honest with my partials. Um, I've now literally over the past 2 weeks put everything in. So I switched from Wells Fargo to PNC, and I do Pinnacle Banking with PNC, so I can do ACHs versus Wells Fargo. It's like, okay, mails a check, it takes a week to get, and it's actually a pain, to be honest with you. Um, I set everyone up on ACH now, and what I'm going to be doing come 1st of May is I'm just I put in, like last year, what I did in Wells Fargo, I put in the full 12 months of payments for all my partials for that year and let them ride. Put everything in Wells Fargo, and then basically it's probably took me an hour and a half. So every payment was going out. I set it for January, February, March, April, May, June, all 12 months, first of each month. Here are the payments that are going out that day. Now, one of the things you're going to be careful of when you do that is when I send checks, there's 2 checks for each partial, a principal and an interest. And this is this key point. Whenever you pay anybody with in the note space, you want to make sure you label it whether you're paying them principal or interest, because at the end of the year, the 1099, your bookkeeper, whoever, needs to know how much you paid in interest. So, what I'm doing in the process of now is I'm putting in what they call them batch files or whatever. So I've started putting in batch files for May, June, July of every partial I have and all the payments. And then it's automatically set. So on the 1st of the month, boom, ACH is right into their account. Other than that, that's basically it. Of course, I check to make sure borrowers are on the loans are paying and current, but that's just part of normal business operations. I don't have to worry about, okay, did the demand letter expire, what's the next step, and all these other things. It's basically, it's no different than having a performing loan. The only difference is that when the money that comes in, I'm paying some of that out. One of the biggest challenges that I had with the partials was getting an attorney agreement, because you got to be careful with the partials, and here's why: you're selling partial payments that you're keeping control of. So are you selling a security? Because they're passive, they're expecting payments. It really doesn't pass the Howey test until you get to the point of, which it says in my agreement, if it goes non-performing, you become involved in a decision maker, or basically you get we have the discussions on what the next steps are. So then it basically reverts back to trying to make them a business partner. So question was asked: services don't distribute? No, and no. So actually, and that's better in some sense, because if I get a March payment that the borrower makes, so here's the other thing is you do go cash negative in the sense of you're putting money out before it comes in, because Allied typically will pay around the day they get the money. But if you're using like Madison, that payment comes in March 1st, you're not seeing it for 3 weeks later. So, and here's the thing: if you've got 10 or 20 of these and you've got the servicer sending payments and the payment isn't made to them, that person's going to say, my payment wasn't made. Okay, now I got to go figure out what's happened, so forth, so on. It's 10 minutes of time times 10, it's 100 minutes. You just spend an hour and a half each month at least chasing down money. So I cut to the chase with that and basically be like, nope, money comes into me, money goes out to them. And it's almost treated as 2 separate transactions in the way I manage it. My deal with the borrower is one, my deal with my partial person is another. Now they're still kind of connected, but if this one fails, what am I doing here? I'm not solely relying on this to do this. If this one is 2 weeks late, the person still gets paid. and and then when you're dealing with IRAs and stuff, because it takes them time to put the money in the account, you would just spend your entire time fielding phone calls that would be, I didn't get paid, or why do I only get paid this amount this month, or whatever it may be. When you've been around this business a long time, you know you'll realize that you try and keep what your servicers do, and this is not a knock to servicers, but you'll find that you'll want to try and keep what you have them do limited to the least amount possible, because the more that people do, the more potential there is for errors. I'm curious if anyone has partials, if they split it and have the services. I know some people, turn around and basically sell a partial. They give it to that person to manage. And it's like, okay, it's your note, you're managing it now. For me, I'm like, oh, no, 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 because, I got back end interest in this thing. I don't want somebody who has no clue what they're doing, trying to figure something out, especially if it goes non performing. So someone said, if I were to sell partial from IRA, I'd want to have an IRA LLC. Well, your IRA should already be an LLC if you have one. Whether it's with, New View, Quest, or whatever, you already are an LLC. What are the questions people have? 401k is a trust. It is a trust, but it's an LLC. You have an EIN number for it? Because I have a solo 401k. Seveney Construction 401k LLC. Trustees Christopher Seveney and my wife. It doesn't say my wife. She has a name. And that's why I also like using my IRA for performing notes, because it's non-performing. Your name is like jumps out at you on the documentation. Now, some people set up the, those land trusts and all that other stuff. For me, I don't, because I don't understand them, and I'm not sure what benefit I'm going to have for them. But on a performing note, anyways, I'm not worried about having, my name out there. Okay, if nobody has any more questions, we'll wrap it up today, right at an hour. So I hope people found this very beneficial in regards to understanding partials, to target, ways that, again, you're buying something at, 12 to 15%. If you can turn around and sell, a component to it for 10%, you get to keep, piece of a sandwich, and, take a little bit of it up front. What type of agreement did you say you use for sale of partials? Do you use an attorney where you live the draft? I use the same attorney to do all my documents. So hold on, let me pop up the agreement. I have one for note, CFD. They're the same. The only difference is one says land installment contract. The other one says, mortgage deed of trust. This agreement entered on this day. So who's the agreement? Here's the information on the land installment contract. This is a CFD, and it says, okay, it was attached, and I attach Exhibit A, which is the actual contract and documents. And this is, their terms. And then here are the terms of the, person buying the partial. And it just continues to go on. Prepayment, what's their payment if it's paid in advance, what's the term or the rate. So the other thing that I'll show is default resolution. So what I do is, should it be in default for a period of 120 days or longer, seller and buyer must consult with each other regarding resolution strategy for defaulted asset. Kind of not selling a security because you're involved. Similarly, buyer and seller should discuss the entitlement. Parties here to agree that in default, I can cure the default and terminate the agreement within 60 days by paying them, basically in full. Continue paying them if I want, or pursue foreclosure at my sole expense, and at the conclusion, pay them their fee. So in essence, I technically could stop paying somebody for 120 days. Then after 120 days, I have to keep pay them off, or pursue foreclosure and pay them off. Now, what I've honestly done typically is continued to fund. So, and all this other good fun stuff that's in here. But that's basically the notes and bolts of it. It's a 6-page document, which actually it's really 4 pages because I have the Exhibit A and Exhibit B page as well. So pretty simple document in that sense. But yes, Brian Gallagher is my attorney out of Council Barradell. He's a real estate attorney, very involved with notes, represents some hedge funds and stuff like that as well. So he writes up all my stuff for me. Any other questions? Oh, thank you all for joining me today. And if anything comes up, let me know and be happy to